Warren Buffett is considered by many the best investor of all time. He achieved a compound annual growth rate of more than 20% since he became CEO of Berkshire Hathaway in 1965. Berkshire is the holding company through which Buffett makes his investments. But how could Warren Buffett be so successful in his investments consistently and over so many years? Well, through a lot of interviews and Berkshire's letters to shareholders over the years, Buffett laid down his rules and principles that made his success. Those rules can help you become a better investor. So, without further ado, here is the wisdom of Warren Buffett in 8 rules for successful investing. Number 1. Develop an owner's mindset. Warren Buffett learned in the early years that no one can know for sure where the stock market is going in the short term. So he focuses on the underlying company and not the ticker symbol. What matters is the fundamentals of the company, where it came from, where it can go, who the management is, and so on. If a company has wonderful economics, it is a good candidate for a wonderful investment if bought at a fair price, but more on that later. If the stock price is going up or down, it doesn't matter. What matters is if the underlying company is getting better and better and making more and more money. So, the movement of the stock price, technical analysis of charts or macroeconomic news that do not directly affect the company are just information that has no effect on Buffett's investment decisions. The stock market is just that, a market that allows you to buy and sell ownership of companies. And that is the mindset of Buffett. He is buying businesses, not stocks. He has an owner mindset. Before buying a company, ask yourself, would I buy the whole company at this price if I could? If the answer is no, maybe you should not buy any shares of that business at all. Number 2. Focus on long term. Buffett's favorite holding period is forever. He likes to buy businesses that he can hold as long as he can. The events, news, and everything else that happens are just noise if they don't affect the long-term view of the business. He only sells if the fundamentals of the business start to decline. There are a lot of reasons to invest for the long term. First of all, history shows us that markets can be very irrational in the short term, but in the long term, the markets tend to follow the performance of the underlying business. So if you choose good businesses, the risk gets lower the longer your time horizon is. Also, history tells us that most investors are bad at timing the market, and in some countries you pay less taxes if you hold longer. But the most important reason to acquire a long-term focus is the fact that you don't interrupt the wonder of compound interest. If you focus on the short term, buying and selling will happen often, and this lowers your returns. The commissions and fees of the transactions can add up to substantial amounts, but the taxes that you paid is what will slowly crush your returns. This happens because you interrupt the compounding. Let's see an example. John is a short-term holder. Let's assume that at the end of each year, he needs to pay taxes on his profits. Jane is a long-term holder. She holds her stocks as long as she can. Jane only pays taxes when she completely sells her positions. We assume they both start with $10,000 and both get a 10% return per year. After 30 years of investing, they both liquidate their portfolios. For simplicity purposes, let's say they both pay 30% tax on capital gains. Here is the results. As you can see, the difference is not that small. After 30 years of investing only $10,000 in the first year, Jane has $104,000 after taxes, and John has $71,000. The difference is 3 times the initial investment. And we are assuming that John achieves the same return as Jane, which is not very probable because he has more commissions and because it is very hard to time the market. Number 3. Buy only companies you understand. Warren Buffett was very criticized for staying out of technology companies. For him, tech companies are out of what he calls his circle of competence. The circle of competence is a simple concept. Through life experiences, work, hobbies, studies, or your interests, you develop some knowledge in certain areas. You should stay invested in businesses in those areas or areas that you understand. Even if you never worked in the restaurant industry, the business model of a restaurant is fairly simple to understand. All those areas that you have knowledge in or that have simple business models make your circle of competence. That circle is different from individual to individual, and, when investing, you should stay within your own circle of competence. This is because when you invest in some company with an owner mindset, you should know exactly how the company makes money and what can or cannot affect the company. If the company is out of your circle of competence, that job will be very hard and probably not that accurate. Also, if you understand the economics of the company you invested in, it is way easier to handle the inevitable drawdowns that happen in the markets. If the company is part of your circle of competence, it is possible to identify if the drawdown is just caused by the irrationality of the market or if the fundamentals of the company are actually in danger. Knowing all of that allows you to make way better investment decisions. It's important to note that your circle of competence is not static. You can grow it. One company that is not within your circle of competence now can be in the future. That's why, as an investor, it's very important to keep learning. Number 4. Buy companies that have a moat. In Warren Buffett's strategy, it's very important to invest in companies that have a strong and sustainable moat. But what is a moat? A moat is a hole around a castle, usually filled with water, to protect it from enemies. This concept applied to stocks means that the company has a strong competitive advantage that keeps competitors away. When a company starts to make a lot of money, it is normal that competitors start to appear. If the company doesn't have any advantage, it is likely that the profit margins will start to shrink. But if the company has a strong moat, the competitors will not be able to easily enter the market. But how do you find them? Well, start by checking the return on invested capital of the business. If the ROIC is high and consistent for a lot of years, it's most likely that the company has a moat. The moats can appear in many forms, and a business can have more than one. Let's take a look on some of the most common. Brand. If a company makes the name of their brand so big that the consumer is buying the brand or the lifestyle provided by them, and not only the product, the company made a moat for themselves. Examples of companies with this moat are Coca-Cola, Harley-Davidson's, or even Apple. Secrets. When a business has a secret recipe or some patent that doesn't allow competitors to produce the same product, that company has an economic advantage. Examples of this moat are companies like Pfizer, that have a lot of patents on some of their drugs. Toll bridge. If you want to make a trip on a train, chances are that you will not have much of a choice about the company that owns the railroads. That is because after a company builds a railroad, it makes no sense for a competitor to build another one next to it. That makes you locked to that company. If you want to use the train, you need to pay to that company. There is no alternative. This is called a toll bridge moat. Another example are electrical grids or gas pipelines. Switching cost. Some companies deliver products that are so rooted in the systems and procedures of the clients that changing them would be very painful and costly. If a company uses Adobe softwares as a base of their business model, the cost and time required to change software is just not worth it. They would need to train the employees in the new software, which can cost a lot of money, and in the beginning, the company would be way less efficient. That's why Adobe has a strong moat. If they need to raise prices for some reason, it is very likely that their customers will just continue to pay for their services. Network effects. Companies like Facebook have a strong network effect. Every user that registers on the platform makes it better, which makes more users join, which makes it better, and so on and on. After the company has a lot of users, it's hard for a competitor to come in and disrupt the business. Price. Some companies have a price advantage. Walmart or Costco are examples of this. Because of their size, they can give prices to consumers so low that it makes it very hard for a competitor to enter their market. A moat is a very important characteristic of a business you invest in. If the company you invested in doesn't have a sustainable and strong moat, it is very likely that it will be, sooner or later, disrupted by a competitor. Number 5. Bet on capable and honest managers. One thing that Buffett always made sure in his investments was that the underlying business was managed by good people. Good for him means that they are very efficient and capable in running the business, but also that they have integrity. The management team of a company has the power to make it thrive or go bankrupt, so it is a very important aspect when you decide to invest in a company. When assessing the quality of the management, it is very important to check the incentives. Are they aligned with the shareholders, or the management is just there to receive their paycheck and drive short-term results for some bonus pay? Is their compensation exaggerated? They own any shares of the company they manage. A good management team focuses on the long term sometimes at the expense of short-term results. It assumes the responsibilities when the results are bad and always tells the truth to the investors. Warren has the possibility to meet these people and talk with them. For us, common investors, The only way to access the management team is through a lot of study of the team members and their past work and experience. Also, it is important to check what happened to the return on invested capital of the business since they stepped in. You want to see it stable or growing. And make sure you read a lot of 10Qs and 10Ks and listen to conference calls. How do they sound? Like honest management or like a snake oil seller? Number 6. Ensure a margin of safety. We know already that Warren Buffett's strategy involves buying great businesses. But at what price? Before buying any stock, you should know the value of the business. For that, the most common way is to do a discounted cash flow analysis. The details of that will come in a later video, so make sure you subscribe, but basically you estimate the future cash flows of the company and discount them to present value at an appropriate rate. This is not an exact science, but is fairly simple to do. What is important after is to have a margin of safety. We are trying to predict the future here, so we need to assume that we will be wrong sometimes. To prepare for that, we use the margin of safety. That means that we only buy a company if it is well below the intrinsic value. Our margin of safety is the discount in the price compared to the company intrinsic value. The bigger the discount, the less risk we are taking. To do this, patience is your best friend. Most of the time, you will need to wait years for a good company to have a good margin of safety. But believe me, it happens. If you have the patience, you will be rewarded even when you are not precisely correct in your estimates of the future cash flows. Number 7. Be greedy when others are fearful. To be successful long-term in the markets, like Warren Buffett, you need a lot of patience and control of your emotions. Most of the time, you need to go against the crowd. A famous quote from Warren is, "Be fearful when others are greedy, and greedy when others are fearful." Let's understand this quote better. Usually in a bull market, it is easy to make money in stocks. Everything goes up, which makes more and more people come to markets, and the momentum is only upwards. This is where greed starts to appear. Stock prices go way over the value of the underlying company, and everyone seems to be a stock market expert. At this time, most people are greedy and take unnecessary risks. But not Mr. Buffett. At this time, he starts to be fearful. Sometimes it takes years, but sooner or later, the prices in the stock market get so stretched up that it gets unsustainable and the trend reverses. Stocks start to go down fast, and panic steps in. While everyone is panicking and selling, Warren Buffett is starting to get greedy and waiting patiently for the prices to go lower than the value of the underlying company. While there is blood on the streets and everyone is a pessimist, he starts buying, being greedy when others are fearful. It's important to note that Warren can do this because he understands and knows the value of the businesses he wishes to buy. Number 8. When you see an opportunity, take it. A lot of people talk about diversification, but for Warren Buffett, if you know what you are doing, you don't need to diversify that much. He is known for having a very concentrated portfolio composed for very few companies, but those companies have a lot of quality and were bought with a big margin of safety. Buffett's advice is that you know the companies you want to invest in, know their intrinsic value, wait patiently for a big margin of safety, and when that happens, you bet big. If you know what you are doing, you should not be afraid to seize the opportunity because they don't happen that often. So, most of the time, if you invest the Buffett way, you will be seated patiently on your ass until the opportunity comes. But when it comes, take it. Berkshire's portfolio is 40% of Apple. Buffett is not afraid to bet and to bet big when he knows the odds are in his favor. Investing like Buffett is very simple, but certainly is not easy. Emotions are your worst enemy here. Not everyone can be like Buffett, but his teachings can help you a lot finding the right strategy for you. To become rich and successful, it's very important to know why you are investing and what your strategy is. Buffett became one of the richest persons in the world because he mastered the engine of money that makes fortunes. If you want to learn how you can do it too, make sure you check this video right here. This is all for today's video. Until the next video, keep compounding wisdom and invest smart.